Hello, students. Before we begin today's lecture, I'm happy to announce that our website, Paperwala Hub, is officially live. For free IGCSE, O, and A-level accounting notes, Paper 1 and Paper 2 topical and yearly past papers, go visit www.adeelpaperwala.com. Hey everyone, and welcome! If you're an O-level accounting student, you've come to the right place. Today, we're going to break down a concept that is just so fundamental to getting your accounts right: the difference between capital and revenue expenditure. Let's jump right in. So here's how we're going to tackle this. First, we'll talk about why this whole classification thing even matters. Then we'll define each type of spending, apply the rules to a real-world example, work through an exam-style question, and finally, look at what happens when things go wrong. Sound good? Let's get started. Okay, so let's start with a really basic idea. Businesses spend money all the time. They pay for buildings, salaries, electricity, you name it. But, in accounting, we can't just lump all that spending together. We need a system. And that whole system really boils down to one simple but super powerful question. How long is the business going to benefit from this particular spend? Are we talking about a short-term boost, or is this a long-term investment? Honestly, this one idea is the key to everything else we're going to talk about. And this brings us to our two big categories. On one side, you've got capital expenditure. This is for stuff that's going to help the business make money for many years to come. And on the other side, we have revenue expenditure. This covers all those day-to-day costs that get used up pretty much within the current year. This right here, this is the golden rule we're going to keep coming back to. So why do we care so much? Well, getting this right is absolutely crucial. It has a direct impact on the profit you report at the end of the year. It completely changes the value of the assets you show on your statement of financial position. And at the end of the day, these are the numbers that owners, investors, and banks use to make huge decisions. So yeah, it's a pretty big deal. All right, let's dive into our first category and see how this works. We're going to start with capital expenditure, the spending that's all about building for the future. So the official definition is any money spent to buy a non-current asset, to significantly improve it, or to get it ready for use. A good way to think about it is this: if the spending adds long-term value to what the business owns, it's capital. Simple as that. So how do we handle this in the books? Well, it's not treated like a normal expense. Instead, it gets recorded as a non-current asset on the statement of financial position. Then, that cost gets spread out over its useful life. That's a process we call depreciation. Now, the most important point here is that it does not reduce your profit all in one go in the year you buy. Okay, so that's one side of the coin. Now let's flip it over and look at revenue expenditure. This stuff is all about the here and now. The cost of keeping the lights on and making sure the business runs smoothly every single day. Formally, it's money spent on daily operations or just maintaining the assets you already have. We're talking about things like repairs, electricity bills, and salaries. These are all recurring costs. They keep things working, sure, but they don't fundamentally improve the assets or add any lasting value. And, as you might guess, the accounting treatment is completely different. Revenue expenditure is treated as an operating expense. It goes directly to the income statement, and it reduces the profit for the current year all at once. It doesn't create an asset, so you won't find it anywhere on the statement of financial position. Okay, theory is one thing, but let's make this really concrete. We're going to apply these rules to a super common scenario: buying a new piece of machinery for a factory. All right, have a look at this list of costs. The purchase price of $150,000, that's a no-brainer. It's capital. But what about the rest? Let's ask the question: are import duties, transport costs, and insurance while it's on the way necessary to get the machine into our factory and working? Yes, they are. So they're all capital expenditure. Same goes for installation and even the trial run to make sure it works. They're all part of making the asset operational. Now, the last two items here are the interesting ones. Training employees, fire insurance. Are these needed to get the machine working for the first time? No. They're ongoing costs of using the machine, and that makes them revenue expenditure. See the difference? So when you add up all those capital items, the price, the shipping, the installation, and so on, the total cost of the machinery that will be recorded as a non-current asset is $202,500. This is a perfect example of bundling all those necessary costs into the value of the asset itself. All right, you've got the theory, you've seen an example. Now let's put you to the test with a typical exam-style question. And while we're at it, I'll introduce a really handy little idea called materiality. Okay, here's Amelia's new business. Let's go down the list. Premises, that's a long-term asset, so it's capital. Office furniture, same logic, it'll last for years, capital. Now, what about the carriage on the furniture? Well, that's a cost to get the asset ready for use, so it's also capital. Legal fees for buying the building? Yep, a direct cost of buying it, so that's capital too. Computer and its installation? Both capital. But what about stationery, ink cartridges, and printer paper? These are just day-to-day running costs. They'll be used up fast, so they are definitely revenue expenditure. Now, you might be thinking, hold on, a $10 waste bin can last for years. Shouldn't that be a capital asset? And that is a great question. This is where something called the materiality concept comes in. It's basically a common sense rule. Can you imagine trying to calculate depreciation on every single stapler in a huge office? It would be a nightmare for a tiny, insignificant amount of money. So, if an item is so small that it wouldn't change a decision maker's mind about the company, we just treat it in the easiest way, as a revenue expense. It's all about being practical. So, we've said over and over that getting this right is important. To finish up, let's look at exactly what happens when you make a mistake, because this is a really common topic in exams. Let's break this down. First, what if you treat a capital purchase, like a new computer, as a revenue expense? Well, you've just put a huge expense on your income statement that shouldn't be there. That means your profit for the year is going to look much lower than it really is. It's understated. And since you didn't record the computer as an asset, your non-current assets are also understated. Now let's flip it. What if you treat a revenue expense, like a repair job, as if it were capital? You've left an expense off your income statement. That means your profit will be overstated, making the business look more profitable than it is. And your assets will also be overstated because you've added value that isn't really there. You see, getting this wrong creates a serious domino effect. So let's wrap this all up. Capital expenditure builds long-term assets, and it belongs on the statement of financial position. Revenue expenditure is a day-to-day running cost that goes on the income statement and hits your profit right away. If you get stuck, always come back to that one core question. Is the benefit for many years or just for this year? Getting this right is the foundation of trustworthy accounts. And I want to leave you with this one thought. Don't just try to memorize a long list of what's capital and what's revenue. Instead, focus on understanding the logic, the why behind the classification. Once you really get the why, you'll have the confidence to classify any expense that an exam throws at you. Thanks so much for watching.